Okay, everybody, we're going to go ahead and get started. First of all, my name's David Krajanowski, and I'm a partner at SingerLewak, and I'd like to welcome you all to be here today on behalf of my partners and our team members. In fact, what I'd like is if all of our partners and team members can stand up. They're all in the back, but they're back there. I know many of you know them and maybe have not put a face or haven't seen them in a while, so before you leave today, make sure you touch base with them, or if you need an introduction, let any one of our partners know, and we'll make sure we walk around and do the introductions. Again, this is SingerLewak Academy. A lot of you have been to our previous seminars, and we're doing it on the Tax Cuts and Job Act updates. That's the purpose of today. For those of you, most of you are clients. We have a few people who are friends of the firm here. I'd just like to spend a minute telling you a little bit about our firm. We're a top 100 firm across the U.S., offices throughout California and in Denver. And a lot of people say, what does it mean? And I agree with you, what does it mean? What it means for us is being in the top 100, you all go to have your services done and you're looking for compliance first of all. One of the areas is in accounting. If you get great financial statements, then you're able to borrow more money or get increased bonding, and that's very important. For taxes, compliance is good because if we can help minimize your taxes, that's called an interest-free loan from Uncle Sam. We need to take advantage of whatever we can do to have more money in your pocket to grow your businesses than it is inside of the government. But on the other hand, perhaps I think the most important value that we bring to a lot of our clientele is in the area of advisory services. And in the area, for instance, while we're going to be talking about the Tax Act today, there's one thing talking about the compliance side. There's another thing talking about all the various aspects in tax. And one of the things you're going to learn today, this is going to be a very general seminar going over the major changes in the tax law. But what's really important is we've got to get out in front of every one of you and go one-on-one. You know, sometimes you can go for a physical. You do your annual physical, and it's just a quick one, and you're out. Then when you turn those golden round numbers like 40, 50, 60, and we'll stop there, they're more intrusive. This is one of the ones that you have to have a complete head-to-toe physical just to make sure what the Tax Act is changing and to reinforce some of the decisions that you're going to be making. Plus, a lot of you call upon some of our other specialties, which you'll hear about, our state and local tax practice. So if you're dealing with sales tax issues, property tax issues, nexus, all sorts of good things. We also have the business risk. A lot of you, in case your computer systems go down, and the threat is not if it's going to go down or if it's going to be hacked, as we all know. It's a question of when. So you want somebody outside taking a look at it. That's what I think that we can really bring to the table. And how do we do that? We do that by having the resources that we can access through the group of 100. For instance, Mark Cooke, will be coming on right after myself, heads up the AICPA Tax Committee. So that's the national committee. They were on top of the law. He was on calls probably every week, if not more often. So he knows what's going on. He knows what other people are thinking. He's part of that brain trust of what's happening. We have another partner who's not here, Jeremy. There's 9 people on a board who are working together to set some of the accounting standards or give the input. There's 3 CPAs from private practice, public practice. We're one of the 3. Now, no promises that we can change anything, but we sure can make our and your comments heard. And then the last area is a lot of us are interested in politics or knowing what's going on. And this is not to say, and I don't want to get into politics, Republican, Democrats, or independents, but I just came from a new majority board meeting. And what was interesting is these are all the initiatives that are out for signature right now. The top 5 have already been approved and will be on the ballot either come June or October. You see everything down here below? Let me tell you what 3 of them are. 3 of them are to raise the state income tax 1% each, called the Millionaires Tax. In case you haven't figured it out, we passed the turning point, the tipping point, whatever you want to call it, in the state of California. I'm not saying all 3 are going to make it, but when you look at what's going on in our wonderful state, and these are all state propositions, that's the reason I'm asking you that after you hear about all this, and on the tax areas, that you've got to become involved politically because you don't understand what a big expense this is all going to be. I think that's about it. Oh, one other thing I want to do. You're all going to get a mailer, and if you don't, our next SingerLewak Academy is going to be on what's called an agility, and it's going to be on February 20th back at our training room, same time period we're doing now, and it's going to be working on, have you found the right decisions, or how to find the right decisions? Do you really want to always be trusting your gut? How to avoid burnout and stress, and also how to retool your strategy quickly. We're bringing an outside speaker, so if you don't get one of those mailers, please call your partner, and we're happy to help you get there. So that was my 30 seconds. I promised I told them I would keep it to, but they all know once I get a mic, forget it. So anyway, I'd like to introduce Mark Cooke, our lead tax partner here in Orange County. He'll introduce everybody else who's going to be a speaker today.
Thanks, David. So my name is Mark Cooke, as David mentioned. In my spare time, I chair the AICPA's tax committee that works through lots of things. One of those is advocating for certain changes in the law. We do things like if we see something that we think we can maybe make a difference at, we will write a letter, or we will testify before the subcommittees and things like that. So that's been pretty interesting, sort of a side gig. But what we're here to do today is to talk to you a little bit about something that happened about 39 days ago, which is the Tax Cuts and Jobs Act. It's something that's been in the works for a while. Some of you have been following this. Those of you who follow politics probably remember or recognize some of the angst that was surrounded this particular bill. But it happened pretty quickly. And so this motley crew here is going to talk about different things. I'll introduce them. On the right here is Dwayne Dupree. Dwayne is a director in our tax group in Orange County. He has about 20 years of experience. You wouldn't know to look at him, but he's pretty entertaining. Next is Tom Windler. Tom has a little more than 30 years of tax experience. This is all tax, by the way. And Javier Ramirez is a state and local tax specialist. He's a partner as well in the firm. He does a few other things too, but very experienced individuals up here. They're going to cover areas of the tax changes that are in their particular area. So I was talking to several of you as you entered the room here. People were asking questions about what happened here. And I think what really happened is that there was a tax bill that was passed. There was a lot of political pressure to create a lower corporate tax rate, because what they really wanted to do was to find a way to have companies work more in the U.S. The tax policy behind this was to kind of generate more jobs in the U.S., more commerce in the U.S., and so they felt, the people that were involved in this, the small group of Republicans in the House, basically, and many of you know the details behind this, wanted to get the corporate rate as low as possible. They set out to lower it to 20% from 35%, and they couldn't quite get to 20% because of some of the budget limitations. They used the budget resolution process to get this tax bill passed, and so they were able to get it down to 21%. So that was really a big part of their goal. And the second part of the goal was to make the U.S. system of taxation a little more territorial than worldwide. So a little background here. Under current U.S. law, or law that was in place up through the end of 2017, the U.S. had a worldwide tax scheme for all taxpayers. Now, for corporate taxpayers, it's a partial exemption system, or some would say almost a territorial scheme. For individuals, it's still worldwide. For corporations, the rate is now a flat 21%. So they got two of those things accomplished. And in the process, they added a lot of other things too. They actually created a situation where it was similar to 1986, when there was just a sea change in the tax law. The same thing occurred 39 days ago. So most of the tax professionals are still sort of coming to grips with this, although many of us followed it as it was being developed in the House and the Senate and through the joint committee process and what have you. So we've got a lot of background, probably more than we need. It can get a little confusing when you know all the different types of things that have been written in 2 or 3 different versions of the bill. But let me get started here because we have a lot to cover. The highlights of the bill are, as I mentioned, is a 21% flat corporate rate. Again, it went from 35 to 21, so that's a huge drop in corporate tax rates. That's for C corporations, what some of you know as C corporations. There is a much more generous expensing provision. There's something referred to as bonus depreciation. Many of you have heard that term before. It's now 100% expensing under the bonus depreciation rules, and we'll get into more details there. The Section 179 expensing went from $500,000 up to $1 million. The most important thing I think that many of you in the room will like to know about is this new system for pass-through businesses. It's known as the Qualified Business Income Deduction, referred to as a QBI deduction. This is that thing that you may have heard of. It's 20% of your qualified business income is just a deduction. It's just a made-up number. It's designed to get the business owners that have pass-through entities to get their top rate down to 29.6% from the new individual rate of 37%. Unless you're in a certain kind of business, in which case you're not entitled to that. And we'll get into that a little more too. Another new thing is there's a new limitation on deduction for business interest expense. And there are some workarounds for that. But so if you're a highly leveraged company or if you're a private venture capitalist type company, you might have an issue with this. To the extent you do, there are some mitigating things that you can do to make it less onerous. And then for small taxpayers, there's some changes in the accounting method rules that make it easier to use the cash method of accounting, easier to account for inventories and long-term contracts. So I just wanted to show you something here. I thought when I saw this sort of thing, it sort of opens your eyes a little bit to what happened. I don't know if this thing will work, but if you look at the old law, you'll see that if you were a C corporation shareholder, the top rate, these are just the federal rates, this does not include California, the top rate was 50.47%. If you're an active C corporation shareholder, the rate was just a little bit lower, but around 50%. If you're a partner and you're passive, and many of you know what passive means, to the extent you don't, it just means that you weren't very active in the business, and so you had to pay a little higher tax rate. The rate was 43, and if you're an active partner, it was 40%. So those were the rates for business owners in both a C corporation setting and a flow-through setting. Under the new act, what's known as the Tax Cuts and Jobs Act, you can see the differences in rates. As you kind of work your way down the list there, you'll see that if you're active as a S corporation shareholder and you pay wages, your rate is about 31%. And the same rate applies if you're an active in a partnership. To the extent that you're a C corp shareholder, though, it's doesn't look as good to you, and you might be surprised by that when you say, well, the C corporation has a 21% flat rate. But the way this is calculated is that if you were to pay a 21% rate on your C corp earnings and then distribute the remaining amount, it also gets taxed at 20%. So that's where the 40% comes from. Distributions, dividends are still subject to a 21% tax rate as are capital gains. Those rates did not change. So just quickly, I'll cover the C Corp thing real quick. The corporate rate's a flat 21%. If you're a fiscal year entity in a C corporation, you would blend the rate between the old rate and the new rate for this next 12 months. There's no special rate for personal service corporations. And the business changes are permanent. The individual changes are good through 2025. The corporate AMT was repealed. Another sort of effort to make corporations more competitive, paying less tax. It's the alternate minimum tax, which is there as a system to make sure you don't pay too little of the tax. It was repealed. Net operating losses. On the old law, you could carry losses back 2 years and forward 20. Now you cannot carry them back, and you can only use them to the extent of 80% of your taxable income in the future, but they can be carried over forever. So pass-throughs. They do not get the 21% rate. They pay the individual rate because the pass-throughs means it passes through to your individual tax return where you pay the individual rate. And Tom's going to talk a little more about that in terms of the individual tax rates in a few minutes. So pass-throughs have this new, what's referred to as Section 199 Cap A. That's the section of the Internal Revenue Code. So people that are sort of technical in the field may refer to it as 199 Cap A. But what that is that is the Qualified Business Income Deduction, or QBI deduction. If I get a little too far off or into the weeds, just somebody stop me and ask questions. But I'll just try to explain this the way I think that may make some sense. So the way this works is that you would look at your business income for the year, and you would look at not only your business income from maybe your primary business, but would you would also add up the income or losses from all of your other sort of maybe rental properties or other kinds of businesses that are flow-throughs that come from a partnership or an S corporation or maybe even a sole proprietorship. You would aggregate those numbers, net them together, and you would multiply that by 20%. That result is your qualified business income deduction. So that's kind of that's sort of a starting place. And then to determine whether you get the full deduction, you go through a series of limitations, sort of limiting steps to see if you can take it or not. If you were a specified service business, you are basically going to have some difficulty in taking this deduction if your income exceeds $315,000. And most people in those kind of businesses, it does. So you'll compute some limitations and you'll determine whether you qualify for this thing. And the way it works is that you have the wage limitation, which is right here, which is a limitation based on your W-2 wages that the business itself pays, your percentage of those. And you have an income limitation. It's that is if your 20% amount, let me say it differently. If your total income is less than $315,000 on a married filing joint return, then you can take the full 20%. There are no limitations that apply to you. The moment your income exceeds $315,000 on a married filing joint return, you have to look to a couple different limitations. The first limitation would be that if you're in a specified service business, if you're in a specified service business and your income exceeds $315,000, you basically scale that deduction back until you reach $415,000 in income. So if you're over $415,000 in income, you get no deduction, no QBI deduction. If you're less than that, you might get some. So what that means is if you're in the business of law, if you're a legal professional, if you're in accounting, if you are an athlete, if you're in consulting, I see people here in those businesses, it's likely you will not receive the benefit of this deduction. Advertising, any of those things that you see, health, law, accounting, performing arts, consulting, athletics, financial services, brokerage services. And here's sort of the catch-all category. Any business where the principal asset is the reputation or skill of one or more of its owners. If you have that kind of business and your income is more than $415,000 in 2018 or beyond, you're not entitled to this 20% QBI deduction. So that's what I was like my friend over here. And there's not. It does exclude architecture and engineering, and we think the reason for that is because if you look at this whole bill in its totality, you'll see that if you're in the real estate business of any kind, if you touch it in any way, whether you're in operations management, you're buying, selling, doing anything like that, you will find that there is a little nugget of hope for you, and maybe even some good benefits for you. So that's the QBI deduction. It's 20% of your qualified business income. That's a deduction that you get unless you're subject to one of these limitations. Does that make sense at all? If you're in a just a traditional sort of business, meaning you're not in a service business, your limitation is this. Your limitation is the greater of one of these two numbers, which is 1/2 of the W-2 wages that you pay, or 25% of those W-2 wages plus 2.5% of the cost of your assets that you still have placed in service. So this limitation is the one that will catch most people that are not in a specified service business. So if your 20% deduction is greater than 50% of the W-2 wages paid by the business for the year, then you'll be limited to that number. If that number is, if you have that limitation, you may go to this to see if this number is greater. If you look at just 25% of your wages, and then add to that 2.5% of the unadjusted basis of your property that you have placed in service that you use in your business, meaning not the depreciated version, but the cost amount. If you add the 25% of wages plus 2.5% of the cost of your assets, that number is the other limitation. So the reason this is in here is because if you're in the real estate business, you can take 2.5% of the original cost of your real estate that you're using, and you get it to 25% of the wages that you paid by that entity, and that's your limitation. So if you have a building that you're leasing to maybe your business, you have no wages, you can take 2.5% of the original cost of the actual cost of the building, and that's your limitation. So that will help real estate owners receive this QBI deduction. Again, the QBI deduction is 20% of your qualified business income, and that's designed to get your overall individual rate down to 29.6%. Well, it's not your wages. It's actually if you have an S corporation and you're paying wages. You don't own all of the S corporation. You would just take the percentage of the wages paid by. Is that what you're asking? Oh, it includes everybody. It includes the owner's wages and includes the employee's wages. In this case, the owner's wages count in computing the wages paid by the company. Thank you, Tom. Good question. The question is, do you aggregate all of the entities together, or do you look at each entity and test it by itself? Well, the way the math works is you should get to the same answer. You're going to apply this at the individual owner level. It's really designed to be done on, you might refer to as your Form 1040. When you file your personal return, we're going to look at all of your pass-through income and determine whether it's qualified business income. To the extent that it is, we'll take the income, we'll take the losses, we'll net them all together to arrive at a net qualified business income number. It gets multiplied by 20%, so that's sort of your starting place. And then you determine whether the other limitations apply. If your income is below $315,000 in a married filing joint return, you get to take the full 20%, no questions asked. If you exceed that threshold, you then determine whether the W-2 limitations apply. If you're in a specified service business, you don't get to go that far. You looked at just that threshold, the income threshold. If you're in a specified service business and you exceed the income thresholds, you're completely phased out, then you're done. You don't get the deduction. Yes, I mean, ultimately that's what you do. You would combine the income, you would combine the W-2 wage limitations that your percentage, share of those based on your ownership, and that would be you'd multiply that by 50%. That'd be your limitation under A here, and then you would have the second limitation if you need it. But yeah, you aggregate those, you add them all together. Yeah.
It just went between two lines. Under this, won't the IRS now go back to the reasonable comp and a pass-through so that you're not manipulating the top line that the 50% tax?
David's right. So what he's asking is, in the past, reasonable compensation was something that the IRS would argue about because if you're paying either too low of a wage or too high of a wage based on what that person is doing, you might be able to take advantage of the tax law and game the system a little bit. In this situation, this W-2 wage thing is going to be a big area for people to argue against. In some cases, people in S corporation environments have been paying too low of a wage, trying to sort of avoid some of the payroll taxes. And now they're going to want to do the opposite. To some degree, depending on the facts, there's a lot of different scenarios here that you could have. You may end up trying to create more W-2 wages in order to create a limitation for yourself. You can see if you had $1 million of income and no W-2 wages that it's not an area where you have a lot of capital investment, that paying wages even to yourself will give you a qualified business income deduction. So the service will be looking out for reasonable compensation. But the more important part of that question is that to the extent that you pay independent contractors, you pay people and you issue a 1099 to avoid payroll taxes or because you don't really qualify as an employer, you'll want to re-examine that relationship to see if the worker's really classified correctly. Maybe the worker should be classified as an employee and receive a W-2, and if so, that might increase this limitation so that you get that QBI deduction. So there's a lot of scenarios that we kind of run where we can see situations where we might suggest that you if you're the owner, that you boost your wages up, or maybe you adjust them a little bit. Once you set precedent, though, you got to remember there's sort of collateral effects of all that stuff. So we want to look at to see what happens if we push the numbers around and see if we can create more deductions for you. No, good question. That was specifically carved out that it's not considered qualified business income, and it's also not a W-2 wage for the limitation purpose. So you lose on both counts there. So what you would probably want to do there is if you have partners that are receiving a guaranteed payment, you'll probably not classify it that way. You might, but you might decide that classifying it differently or changing how some of it's classified might be beneficial. No, it doesn't enter into the equation. If you receive a W-2 from a business and you're going through this calculation, that's not considered qualified business income because it's a W-2 and it's not coming from a pass-through or a sole proprietorship. And it also doesn't get used in determining whether you meet the limitation or not. Yeah, you can. And some people will, when we were kind of looking at this thing here, this choice of entity thing, let me get back to this. You might find that if this rate right here, these two rates right here, those assume that you're making distributions and those are taxable as dividends. But if you're not doing that, if you don't see yourself making those distributions, like of all the remaining untaxed income, because you're reinvesting it in the business and you don't see that as happening, you might find yourself better off as a C Corp. We have those situations. Or you might find that creating a C Corp in your sort of substructure, there's a benefit to using that 21% rate. In fact, I've got I was telling David this the other day. I have it's a series of articles written by law professors on all the different ways you can play games with this. When you have this 21% rate, which is so much lower than the individual rate, there are lots of games you can play. We expect there to be sort of the mother of all technical corrections bill in the next year or two. It takes 60 votes in the Senate for that to pass, so we're not sure what will happen, but it sort of needs to happen for the government to operate in a way that's consistent with the budget scoring that occurred when they wrote this law. So, but if you're careful, you can actually use this to your advantage because there's lots of problems with it. Well, dividends, when they come to the shareholder, those get taxed at the same rate as before. That has not changed. It's 20% or 23.8%, depending on your situation. It's probably 23.8. It's not deductible by the company.
So there is a change. Whereas before, if you had S Corp, you would pay tax at the S Corp level, and then when you received the distributions, there was not a second tax. Now you'll pay the 21%, and then when you receive the distributions, you'll pay a 20% dividend tax on that.
You might want to have more than one, though. It's possible that we have clients, we've been out talking to them about their structure. That might be, you might be a situation where you have one S corporation, but you might find that you might want to have a C corp parked, downstream a little bit for a couple different reasons, which we don't go into here. But there are ways to kind of use a C corp as a way to use that 21% rate for a while. Put it in a different jurisdiction, because C corporation is a person in the eyes of the government, and you can use whatever state tax rate you want, depending on where the income's earned, whether it's portable profits and stuff like that. So, it's a lot to talk about there. So, to David's point earlier, you really want to sit down with your tax advisor, and hopefully that's us, and just walk through the different options that you have. You sort of have a range of opportunities here. You can go from being very conservative to pushing the envelope a little bit because of the nature of the law being so unsettled. So we don't have a lot of time left to cover some of this, but I want to cover some of the major things. We talked about interest expense. This is a new thing. There's now a new limitation on deductibility. It applies to all businesses. And I'll just sort of tell you in a nutshell what it is. It basically is, the provision is that 30% of your EBITDA is the limitation for deducting interest. And that's the way it is for the next several years, and then it'll become EBIT and not EBITDA. That's earnings before interest, taxes, depreciation, and amortization. So so if you're highly leveraged, in highly leveraged environments, this may serve to limit your deductibility for interest expense. If you are limited, you can carry it forward until you can use it forever, pretty much. It does not apply if you're considered to be a small taxpayer, and that's defined as a business that has $25 million or less of gross receipts in each of the 3 prior years. So the average is 25 million or less. Here's something that, again, we talked about a little bit. So one of the stools of the legs of the stool, rather, is that the tax policy behind this was to create a situation where there was a lot more capital investing and creating more capital-intensive business, trying to bring back the manufacturing to the U.S., trying to encourage investment in the U.S. So there is a provision in the bonus depreciation rules now to allow for 100% expensing. And bonus depreciation in 2017, for example, was 50% of new equipment. The rule now is that for anything purchased after September 27th of 2017, whether it's new or used, is eligible for full expensing on day one. So if on September 28th you bought an airplane for your business, it's fully deductible, whether it's new or used. It's effective September 27th of 2017. So anything after September 27th of 2017, this rule applies. So it has some implications in 2017. Prior to that, it was 50% of new only, or you could take Section 179 if you qualified. It could. There is a provision that really, leasehold improvements have a 15-year life. Generally, some could be 5 or 7, depending on whether you do a cost seg, that kind of thing. If you do leasehold improvements to an office building, let's say, you're probably looking at a 15-year life, straight line 15-year depreciable life. If you're doing a bunch of build out in a manufacturing environment, you probably have mostly 7-year life. Or you might expense it. You'd be eligible to expense it. Yeah, if you're buying it from a related party, you would not be able to consider that a purchase. So you can't manufacture your own deduction. It wouldn't be deductible until there was tax paid on the gain. So.
And you have to pay sales tax.
And sales tax too. It would do more harm than good. So. Cars actually have a particular. They did increase, as many of you know, automobiles are considered luxury if they're over $28,000 or $29,000 under the tax code. They've changed a little bit. You can now get more of a deduction annually. It's still not that generous. If you have something like a Tesla, a really expensive Tesla, you might, you've got the tax credit already, but you'd get to deduct up to $10,000 for the year you placed in service. This is 2018 and beyond. $16,000 for the second year, $9,600 for the third year, and then you take $5,760 until it's depreciated fully. Do you have a question or point, Tom? Or okay. I'm going to keep going here because I think I want these guys to have a chance to speak. How are we doing on time? Okay. Let me just skip ahead to. I just want to point out the accounting method changes here. This is particularly helpful to companies that have less than 25 million of gross receipts over the prior 3 years. You can now use the cash method of accounting before after you got the 5 or 10, 5 million if you were C Corp. You couldn't use the cash method. Now you can use the cash method. There's a couple things here that I thought were interesting. You no longer have to use the uniform capitalization calculations for those of you who know what those are. Those are just the way of, under the tax rules, still sort of doing cost accounting to capitalize more of the SG&A kinds of costs, the G&A kinds of costs into inventory. But if you have gross receipts of less than 25 million, you don't have to do that any longer. Let's see here. Yeah.
If you're on the accrual method and you're under 25 million, you want to go to the cap automatically, you have to apply.
It's automatic, but you have to use the change in accounting method procedures, meaning that you might get a 4-year spread if there's an income to be recognized. I guess a little complicated, but what Crad is saying is that when you change your method of accounting for tax purposes or book purposes, you go through this process where you determine whether or not you're omitting something or you're doubling it up. And to avoid that, there are procedures in place to capture that benefit or detriment. If it's a benefit to you, the good news is you pay tax over 4 years. If it's a detriment, you get to take it all at once, generally. Any other questions? It wouldn't do you any. I mean, you probably could. It probably wouldn't do you any good because this provision under Section 481, you can see right here. That's the code section that deals with accounting method changes. It's designed to prevent there from being any benefit whatsoever to doing that. You'd probably be more fees for your tax advisor. So maybe I should encourage you to do that.
I was just going to add that California has not adopted any of these rules.
Very good point.
So you could theoretically switch back to cash for federal purposes, but for California, you would still be required to be on accrual. In addition, for the long-term contractors, it's still an AMT preference. So you could theoretically have 3 methods of accounting for federal, AMT, and California.
And we really hadn't gotten into that point, but that's an excellent point for all of you to remember, is that California does not adopt the Internal Revenue Code, does not adopt any of the U.S. tax rules. It has its own tax provisions, and so it's going to create some complexity. The DPAT is repealed for any of those of you who know what that is. That's the Domestic Production Activities Deduction. That's been repealed, sort of been replaced by this QBI deduction. Like-kind exchanges are now available only for real property. It is not available for machinery and equipment or cars. We trade a car in, it now has to be fully reckoned with. It's going to be a particular issue for people who have done a cost segregation on a building, because when you do a cost seg, you're dividing it between real property and tangible personal property. The tangible personal property no longer qualifies for the like-kind exchange. Only the real property portion of that does. Business entertainment expenses. This is something that you'll be hearing more about probably. This is more of a place for games to be played too, but entertainment expenses are no longer deductible beginning with January 1st, 2018. So golf outings, sporting events, performing arts tickets, things like that, they're not deductible at all. Now some tax professionals believe you can make certain arguments that these are not entertainment expenses, that they're done to promote the business or to expand the business and that sort of thing. And so there's some work being done in that area as well. So it's not deductible if it's entertainment, but it might be deductible if it's promotion, advertising, sponsorship, something like that. Let's see here. I'm going to let these other gentlemen speak here on, I think what we want to do is get to the individual section. Tom's going to talk about the individual stuff. I think it's important for you to understand the difference in tax rates. So Tom Windler, tax partner in Orange County, 30 years of experience. It's right here.
Well, I'll try to hold this and click at everything at the same time. The one thing that you'll see, the individual section is going to be very short because most of the law that came about was to help business. Individuals, they really took everything away and didn't really add a lot back other than that pass-through deduction, which I think will be the biggest thing for individuals. So, the individual rates changed. For the most part, if you look here, this is just one example of it. For the most part, the rates went down about 3%. But if you factor in the 20% deduction for pass-throughs, it could be more. Because for a lot of businesses that didn't qualify before for the DPAD deduction, they will now qualify for the 20% deduction. So it can be more. But for the most part, it's about a 3% benefit. The other thing that's not on this chart that I wanted to point out was that for individuals earning $400,000 or less, the marriage penalty has effectively been eliminated, which is a personal pet peeve for me. Not because I'm pro or anti the marriage. It just never seemed fair that if you got married you paid a penalty. So if your income is $400,000 or less now, there will no longer be a marriage penalty for two singles who both had the same amount of income and now got married. Once you get over 400, unfortunately, the marriage penalty goes away. Doesn't go away. In the past, the marriage penalty pretty much started at 40,000 or more of income. So now it's 400,000 of income. There's a lot here. I think most of the things people heard about. The state tax deduction has gone away. It's limited to $10,000. That includes your real estate taxes. But since your rates are going down, the way they're getting the money back is by taking deductions away. Very similar to back in 1986. For the people that remember that, 1986, it used to be you were able to deduct everything, including sales tax, and they took that away. Now they're taking away the rest of your state tax deductions. The mortgage interest deduction will now be limited to $750,000. The good news on that is for mortgages that were around before 2018, you're still getting the $1 million limitation. And in addition, the one thing that's not on here, you still get to deduct your second home. There was a lot of rumors out there that it was going to be one home, but the second home still qualifies. And if you want to think about why did they keep that in, you got to think about the people that are enacting the laws. They're usually Congress people that had a home in their home district and have a second home in Washington, D.C., so they want to be able to deduct both mortgages. Charitable contributions, there was a lot of rumors that they were going to go away. Not only did they not go away, they increased the limitation from 50% of AGI to 60% of AGI. But the one that you'll probably see a lot of people get affected by is that if you contribute money to colleges and universities and in return get preferred seating, those are no longer considered charitable contributions and you get no deduction for it. And then the one that will probably not affect a lot of people because the AMT was limiting the itemized deductions, but miscellaneous itemized deductions are gone now. And where you're going to see a lot of that is your investment management fees, that your advisory fees that you're paying to your investment people were all miscellaneous itemized deductions, and those numbers can get pretty high, but they're no longer deductible. Medical expenses was another rumor that was going to be taken away, but it's still around. Casualty loss deductions, you heard lots of things about how your house burns down in a fire, you're no longer going to be able to deduct that, but again, that was spared. But they have to be federally declared disaster areas, so you got to make sure that, that it's declared federally. It can't just be Governor Brown. What I call the disguised tax rate was the itemized deductions, that you would lose 3% of your itemized deductions, so that way your tax rate was actually higher than 39%, has gone away. So if you are able to deduct itemized deductions, you still will get them. The one that's going to probably affect most people at the lower level is the standard deduction. It's pretty much doubled now. So if you itemized deductions before, you didn't get this, but for a lot of people who no longer had a mortgage or no longer had really a lot of state taxes, they were using the standard deduction, and they're going to see a big benefit this, because a married filing joint before they would get about $12,000, now they're going to get $24,000. Who's going to get hurt by this? It's going to be the new parents, because now the exemptions are going away. So the good news is, before you got $12,000 as a standard deduction, it's now $24,000. But if you had 4 kids and you were getting $3,000 each, those are gone. So there's a trade-off. These are really small, so I'll just go through them real quick. There's no longer a moving expense deduction. The big one, alimony. Alimony now is no longer deductible, and it's no longer income to the recipient. But before anybody that has alimony payments gets worried, this is only for new divorces starting in 2018. If you have an existing agreement, you still get to deduct it, and the other person still has to pick it up as income. So again, the law before was geared against being married, so this is something to keep you married. There's other things on here. I think those are probably the big ones. You heard about Senator Rubio was really having a hard time with the new tax act. So what he did was he said he wouldn't let it happen unless the child tax care credit was increased to $2,000. So that's the section that Senator Rubio was responsible for. And there's a refundable portion of $1,400. So even if they don't pay any tax in, they can still get $1,400 back with that. The alternative minimum tax, which we were promised was going away, did not go away. But they significantly increased the threshold. And now that you're no longer deducting state taxes, and now that you're no longer adding back those exemptions for children, there's going to be a lot less people paying AMT just because of those 2 reasons. And the sneaky one that I really am surprised you haven't heard about is that the estate tax, the lifetime exclusion, doubled. It went from $5.6 million to $11.2, and that's huge. Basis step up was retained, and the 40% tax rate's still there. The one thing that I didn't point out on all of these, though, everything right now is scheduled to go back to where it was in 2026. So everything has a limit. So if you remember 2010, when the estate tax was supposed to go away, and then it was supposed to go back to $1 million, and you had people that they were talking about, death planning, where if somebody's on a life support system, you'd pull the plug right before because it would cost you millions in estate tax. You're probably going to hear this again in 2025. The gift tax did not change. There's still the annual gifting, but after about 8 years, they finally increased it from $14,000 to $15,000 a year for annual gifting. So that's pretty much the individual side. As I said, the law was really set up to gear towards businesses.
Well, a lot of people have heard about the savings tax at the high state.
Yes. Yeah, the one thing that that was out there when I talked about the state tax deduction going away, there's a thing, what's it called? The California Empowerment Fund, I think is the term they're using right now. It's been proposed. It's been proposed by Representative De Silva, I think's his name, who for some reason wants to run for governor. So he's putting this out, and what that would allow you to do is, let's say your state tax liability is $200,000. It's way over the $10,000. If you lose the 200, it would allow you to contribute $200,000 to the State Empowerment Fund, and in return, they would give you a dollar-for-dollar credit on your California return. So now you get a charitable deduction for $200,000. You get a 37% benefit of that. You save $74,000 there, and you get a $200,000 benefit. So you're actually ahead by $74,000 by contributing to this fund. Sounds good, but the problem is that, and I always thought that no different than when you go to a dinner, when you contribute to a college, and in return you get football tickets, or you go to a dinner and in return you get a dinner, or you contribute to the silent auction and in return you get sports tickets back. You're supposed to reduce the amount of your contribution by the benefit you got. So if you're getting a benefit for this, a lot of people say that you're going to not get that deduction and that it's not going to fly. What people are hanging their hats on is that a lot of states have done this to a much lesser degree. And what they've done is they've said, if you give to a college or university, we will allow you to get a credit for that college or that deduction off your state taxes. And it just encourages you, and you have to be a resident of that state. So if you live in Illinois and you give $5,000 to the University of Illinois, and I'm using that as an example because that's one of the states that has done this in the past, then you get, and you pay Illinois tax. Obviously, if you're a California resident, you're not paying tax to Illinois, you're not getting a credit, so you're not going to take advantage of that. But if you live in the state, you give them the money, you get a credit. And technically, you are getting a benefit, and there's an internal memorandum where the IRS just said, yeah, we know they're getting a benefit, but we're just not going to pursue it. Well, now if all these states, including New York, New Jersey, Pennsylvania, that are coming out with this start doing this, and now we're not talking about a $5,000 college university contribution, we're talking about a $500 million contribution. There's going to be problems. There's going to be people arguing. Already there's going to be lawsuits. Everything that I've read says they don't think this will fly. There will probably be technical correction bills where they specifically say that if you get a benefit, you won't get it. So as of right now, there is nothing in the law that says that, but you're going to be reading about it a lot. In fact, they were very smart. January 3rd, it came back to work, and the first thing I read in the paper was about this California empowerment zone. But here we are 28 days later, and it hasn't really progressed any faster. So it's just something, yes. The sales tax is part of that $10,000 limitation. So between property tax, income tax, and sales tax, yeah, unless you...
Unless it's part of a
I'll tell you
business.
who will get to use it is if you live in Texas, so you're not paying any income tax, you rent your house, so you don't have any property taxes, then you probably can still use the sales tax deduction.
Unless it's part of a business, then you get to take it.
Yeah, everything, I'm assuming your question's about the individuals, right? Any other questions? Okay. Guess I'll turn it over to Wayne to talk to you about international.
This is really a central part of the Tax Act, the international provisions. Something to pay attention to. It's
All right, I'm going to talk to you, give you some of the major points of the international update. Unfortunately, it's always been a complex area, so sorry to disappoint, but it's going to be just as complex probably as ever with probably a lot of changes. one thing to think about if your company is involved with foreign operations, you're probably going to have to do a lot of analysis over the next couple months to year and think about different ways to, maybe restructure and things like that. So just to keep that in mind as we're going through these slides. So the top line there says, migrating from a system of worldwide taxation, which Mark's talked about a little bit before, to a participation exemption system. What does that mean? So if you think about it, with an example of something I'll dig into a little bit in some of the next slides is the idea of having to pick up income in the U.S. when you have a dividend. So for example, if you have a distribution from a foreign company, that's usually the first time you pick up the income. Well, now the new idea of the exemption is you have a dividend received deduction, so you exclude 100% of that dividend income into the U.S. income. So that's an example of that. I'm going to talk a little bit about intangible property and this idea of this GILTI tax and the FDII, and it's an issue of where you hold intangibles and where the income's sourced. And there's some incentives, obviously, to have the intangibles here in the United States, and that obviously that's the push for a lot of these different foreign laws that have passed. So let's take a look at one of the first topics, which is the foreign dividends. And so what I was mentioned before is under the prior law, you used to have foreign income, and you really didn't. You could kind of ignore it for a long time until you had to make a distribution, from the foreign entity into the U.S. and have dividend income. And so now with the new law, you're going to have that same transaction. You're going to have to try to, bring that income into the U.S. But there's 100% dividends received deduction if there's more than 10% owned of that entity. So obviously a huge tax incentive. And the flip side of that is if there's foreign tax credits, you obviously can't kind of double dip, so you can't those aren't allowed. This applies to most C corporations. There's a few exclusions you'll kind of see there in the middle there, and this is effective after 2017. Obviously, the action steps there. You kind of have to think about what are your needs of bringing cash into the United States, and this might be, obviously a good time. So deemed repatriation, and when I read this, it sounds very expensive. So if you've been following some of the news, this obviously, you see, companies like Apple and that type of thing, having to sort this out. So if you think about it, there's this idea now that you're going to have to bring in an E&P study, basically, and all of your foreign income, you're going to have to basically pay a tax on. So that tax rate is 15.5% on cash and cash equivalents. So that's things like accounts receivable, and then 8% on the rest of the items. So this goes back to post 86. So if you can imagine, this could be, like I said, sounds expensive. So one of the things that they've done to kind of help spread that out is there's this, if you kind of see listed down below, is there's this 8-year installment. So the idea is you kind of build up the payments over time, so you're not just getting this one-time hit to the taxpayer. One thing you see kind of the action steps is you're probably going to have to perform some kind of E&P study to see what is what does this amount to for each of the taxpayers. And there are some favorable rules under the S corporation statutes, and that's that you can elect to defer this until you have what's called a triggering event. Some of the trigger events they listed were, if there's a sale or a transfer of ownership. So you could, obviously defer this out quite a long time if you're an S corporation. So something to think about if you're an S corporation. So I mentioned before there's two different concepts. One is the GILTI and one's the FDII. So under this GILTI, Global Intangible Low Tax Income, you're going to have to pay a tax. So when you have offshore intangibles, and so obviously the incentive of both of these laws that I'm discussing is to have your intangibles here in the U.S., and obviously you're earning as much income here in the U.S. rather than overseas. to give you an idea, that the tax for a C corp, it's 21% times 50%, so it ends up being 10.5%. This is effective after December of 2017. So here's the flip side of it. So just as well as you're penalized for having foreign intangibles, if you have things sourced here in the U.S. and owned here in the U.S., you basically get a deduction for those foreign sourced income. And it's obviously, it's a big push to where you have your intangibles. One of the action steps kind of down on the bottom is to think about, hey, do you move, where you're, onshore or offshore for your intangibles. So like I said, there's a lot of planning in these international rules. Let's see, there's a couple other areas I want to cover. Leave a little bit of time for questions and that type of thing. Let's see. Oh, here's one that's, so I don't know if you've dealt too much with kind of setting up a new company and outside of the U.S., but a lot of times there's these hybrid entities and they don't always match up to what U.S. law is. There's a lot of different treatments. Sometimes there's you think it's a company, but it's treated as a partnership and vice versa. So what this is saying is they're monitoring, they're watching this. And so just be aware that you may have to reconsider either the payments or even the type of structure that you have with these hybrid entities. They have to have a matching. So if you have an expense on one side, you should have, income on the other side. And sometimes that has been avoided, but not for long. Let me see. I'll try to cover a couple other things here. Oh. Oops, too far here. So one thing I want to mention is for those of you that have done a foreign tax credit or have had to deal with it, there's two normal baskets, general and passive income. And there's going to be now another basket, and it's this foreign branch income. And so basically what it says is if you have an activity, you have to assign all of the income and the deductions to that specific entity. And unfortunately, what that does is you used to have a little leeway when you kind of allocated, your deductions and, and trying to sort out your credits and where the income was sourced. So you could kind of make the best of both worlds. Now it's going to lower your foreign tax credit just because you're going to have to be so specific with this allocation. So just want to let you know there's probably going to be lower foreign tax credits because of following these rules. If there's any specific questions.
Okay, thanks, Dwayne. Next up is Javier Ramirez, state and local tax partner.
Thank you. This is actually going to go pretty fast with regards to the state portion. The general rule is state tax conformity. How are the states going to actually conform to all these changes? And the general rule is we don't know just yet how the states are actually going to affect, how this tax act is going to affect all these multiple jurisdictions. What we're finding, and what you need to really kind of know about state conformity, is that there's three different kinds of conformity. You have what's called static conformity, where you have where a state will static conformity is when a state looks at the IRC and basically says, as of this date, we are going to conform, right? So anything from this point and prior, everything will be applicable. But after that particular date, you actually have to have legislative change. You have rolling conformity, which is as the changes come in, states will automatically adopt these changes, which there will be some impact. Now, what we're going to see probably is a lot of states that have rolling conformity are going to probably decouple. They're probably going to look at this and say, hey, you know what? These changes are pretty impactful. They're going to affect how we're taxed. So we're starting to see that states are actually having a lot of conversation about what they intend to do. They haven't actually done it yet, but this is the conversation. And then you have selective conformity like California, which actually selects specific things and says, yes, we're going to adopt this, but we are not going to adopt most of the changes. California at this point really hasn't adopted anything. They're looking at everything and pretty much saying, yeah, we're not going to do that. Just the way it rolls. I'm sorry? Surprise. So general conformity, Well, it's basically saying the same thing. This slide basically identifies which states have rolling conformity and which are specific, which are based on specific date conformity. So, like I'd mentioned, with rolling conformity, a lot of states are actually looking to possibly decouple from the from everything that's coming through. Well, with regards to rolling conformity, like I said, there has to be legislative change for them to actually decouple. So they actually have to make an election. They have to go into the legislation and change it for them to actually not adopt some of these changes. And that's going to be pretty interesting to see what states are actually looking to do. So repatriation, we talked, Dwayne talked a little bit about repatriation and what's going to happen with that. Well, why is it important from a state perspective? Primarily from a rolling conformity, you have to really look at that, because if they're pulling income back and saying, yes, from a federal tax perspective, we're going to show income now because we're going to have repatriation of income, subpart F income. So what happens with these states that are actually saying, well, we adopt that, so if you're going to have income coming in, well, is that going to create income from a state perspective on states that have rolling conformity? It's likely that in some states there will be, in some states there won't. So what happens with this is that you're going to, with states that are static, that have adopted as of a specific date, it's likely that this is going to have no change. From a California perspective, California is selective, so California basically says we don't adopt subpart F income, and therefore it's not really an issue for California either. But once again, the key is going to be whether or not these states that have rolling conformity are going to have a taxable income as a result of repatriation. So what happens if you do? So you're in a particular situation where you have states that are actually saying, yes, we're going to have to adopt this, and therefore you're going to have income from that perspective. Well, then you have to look at what you're going to do from a business planning perspective, and that's where you start looking at income tax apportionment. So now that you know that the state is going to look at that and say, yes, we have repatriation of income, it's going to be subject to taxation in our state, you don't want it all taxed in one particular jurisdiction, so you start looking at how you're going to apportion that income as business income, or whether it can be. So it's going to drop into your normal factors. So we're looking at all these different issues and seeing how these states are going to actually apply this. So from California, once again, California really doesn't adopt subpart F income. So from their perspective, they're looking at this and saying, you know what, this really isn't going to be an issue. Subpart F income is only used in determining water's edge. So from their perspective, we're seeing that since California has published nothing with regards to how they intend to adopt or what they intend to adopt, there really shouldn't be any issue from a California perspective, with the exception of when we have repatriation of income is actually received in California. So once it's actually received, then you're going to have a taxable event. Outside of that, this really isn't going to be an issue from a California perspective. These are all pretty much the same as I was talking about with regards to static conformity and rolling conformity. From your technical terminations from a California perspective, you're still going to have to file 2 short period returns. That's just a normal thing that you're going to have to do. Like-kind exchanges, California isn't conforming, so it's the way it's applied from a federal perspective. California, the rules that are currently in place, you will be able to continue to do and act like you normally do. So there's no real issue from that perspective. And the NOLs carryback, from a California perspective, once again, California doesn't conform, so therefore you still have the two-year look-back period for those particular issues for NOLs. And for immediate expensing, so this is one of those issues that you're going to want to take a look at, and it can be impactful to you. So if you have a situation where you have the opportunity to invest, and of course that's the whole purpose of it, to drive the economy, you're going to have 100% expensing. Where you have a planning opportunity is if you're going to make a significant purchase, and you have a state that has rolling conformity, and you operate in states that have rolling conformity, you're going to be able to take a look at this and say, okay, we have a planning opportunity, so we're going to purchase property and we're going to put it in a state that has rolling conformity. So they're going to adopt exactly what's happening here, and you're going to look to the state to determine whether or not there are potential incentive opportunities. So since most states, and of course you're going to see that most states that are going to look at this 100% expensing, and they're going to say, no way, it's not going to happen. We're not going to allow 100% bonus depreciation, and we're not going to allow 100% expensing. So it's likely that we're going to see that you're going to see a lot of states basically decoupling. You're going to see a lot of states that are looking at this and saying, wow, if we allow this, this is going to really impact our budgets. So you're going to probably see states that are going to be looking at this particular provision and say, we're going to decouple from this one. And we're not going to, specifically for the rolling conformity. So this will be, that is going to happen. We've already seen it in a number of different states. So there's a lot of communication basically coming to determination that this is what's going to happen. They're not going to conform. California doesn't conform anyways, so California is just as normal. Whatever provisions you have currently in place, those are the provisions that are going to stay in place. Now, the planning opportunity that we're talking about is this. So the state tax and incentive opportunity. So yes, you do know, like I said, that you do have an opportunity to purchase an asset or move out of California if you're a business that's looking to move out of California, and you're going to be purchasing a lot of assets. You're going to want to take a look at what state incentives are available because you have 100% expensing. So if you're buying equipment, you want to take a look to determine if there's a state out there that has an opportunity to give you a state tax incentive. So maybe you don't pay sales tax, maybe you don't pay property taxes. And if you have rolling conformity, 100% bonus depreciation, or 100% expensing, you're going to be able to benefit from that particular jurisdiction as well. So that's pretty much it from a state perspective. Ultimately, we're looking and making the determination and looking and tracking which states are going to have rolling conformity, what's going to happen with that rolling conformity, which states are going to move towards selective conformity. So that's kind of what's happening now. Unfortunately, we don't have a lot of information with regards to this. This is so new, and we're kind of just tracking it. So as we get information, we will disseminate it to everybody. Well, some of this requires legislative changes, a legislative correction. So it could take some significant time. It could take 6 months to a year, sometimes further. If you're looking at California, it's a really significant time. But since California is really selective in what they do, it's basically they're just kind of coming to the position of saying, hey, we're not going to do anything. We'll let you know when we conform. Yeah.
I was just going to add that if you want my gut feel, Jerry Brown has made it very clear that if it's going to save California money, he'll approve it. And if it's going to cost California money, he'll deny it. So my guess is California will adopt the things that take away like the entertainment expenses, but anything that goes the other way, he'll just veto it. That would just be and that's just a gut feel, because that's the way he's been governing for the last 10 years. Any federal change like expensing or anything like that, they've just denied. Anything that raises money, like IRA rollovers that you tax currently, he's approved because it raises money for the state.
Any additional questions?
All right, thanks, Javier. We can take questions now if you have any more questions. If this has raised some questions that you still have sort of gnawing and like to ask. We'll work with you. We'll work, Sean.
By the way, parking, because I forgot to mention it, on the table right there, you're actually parked here at the hotel, that's really good hotel.
We have a question. Sean, do you have a question?
Yeah, can you talk a little, I saw something about kitty tax.
Mm-hmm.
Briefly talk about how that.
The kitty tax, I can help. We can probably both
Kitty
answer it.
tax, basically what they're doing now is it's no longer. You can hear me, right?
Yeah.
The kitty tax is no longer tied to the parents. It's now tied to the trust rates. So the good news is you don't have to wait till the parents' return's done to calculate it. The bad news is the trust rates are so high, so fast that it could end up costing you money. But you still get the first $1,000 free. So as long as you keep it under $1,000, you're fine.
Other questions, sir?
On the 179, I saw a $1 million cap, and then if we flash by, I saw something for 2.5 million.
They raised both the Section 179 limitation. It went from $500,000 a year to $1 million a year, and then the phase-out threshold went from went from $2 million to $2.5 million. They raised both of them $500,000. So what that means is that if you, to the extent that you place more than $2.5 million of assets in service in a particular year, for each dollar in excess of $2.5 million, it lowers the $1 million deductibility number. So if you had $3.5 million placed in service, your 179 deduction would be zero. Would go from 3.5 million minus 2.5 million is $1 million. That reduces the $1 million down to zero. So it's dollar for dollar over 2.5 million is the threshold reduction. Michael?
When I saw it, you kind of flashed it through. Was there any other caveats that S corporation I saw kind of similar, but you didn't work on that one? Is there any caveats?
In the S corporation area, the thing that you saw flash through is if you go from S corporation to C corporation and there's an accounting method change, there is a sort of a mitigation provision on the taxability of distributions made after you adopt the C corporation status. If you make distributions that are relate to the S corporation years and you're now a C corporation, you may still be entitled to use the S corporation AAA account to make those distributions. There's lots of stuff buried in here. This is a very sweeping tax law change. So it would take a while to actually go through each component of this. What we tried to do is to give you some of the highlights, but Mike, to your point, there are all sorts of provisions here that we haven't talked about. There is for example, there's a credit, an actual credit for wages paid to employees that are on family leave, to the extent that you pay them at least 50% of their wages during their family leave. You're eligible to take a credit up to 12.5% of those wages paid. And to the extent you pay more than 50%, you get another quarter point increase in that tax credit. So it's a credit, it's uncapped. So for the next, for 18 and 19, you're able to take this tax credit for wages paid to individuals. They're employees of yours, they're on family, medical leave or family leave. Stuff like that's buried all over the place. The thing I think is important, the stuff that Dwayne covered, I know that you're listening to 4 tax geeks speak, so we're speaking as much English as we know how to speak. But and I realize a lot of this stuff probably didn't make any sense, but the point I think is that it's a sweeping tax law change. It impacts individuals, it impacts businesses, it impacts international sort of parts of your structure. The state local piece is fraught with all kinds of landmines because the states either adopt the federal tax laws or they don't. If they do, they still make a lot of modifications to it. They'll be making more modifications. Javier referred to that as decoupling. There's a lot of things to consider in your business, so it's really important to really take this as an opportunity to really explore your tax structure, your structure, to see if you can optimize it from a tax perspective or not, or to at least avoid, if you happen to be in a specified service business, to avoid some of the implications of it if you can. So it's just really a wake-up call to think about how it affects you. Good.
Or perhaps you're thinking about selling the business in the next 5 to 10 years, and there's a rate to become a C corporation.
We really didn't ask him to ask these questions, but it's a good question. The question is, what happens if you're thinking of selling your business? Maybe you're not thinking of it, but it could happen. The question is, do you change your structure? Do you kind of position yourself to optimize or get the best sort of optimal tax benefits at a sale? The question is probably. It depends on how you're structured, but if you're structured as a C corporation or you're thinking of going to C corporation status to get that 21% tax rate, and you're also thinking of selling your business in a few years, 5 or 6 years, you may be exposing yourself to double taxation on the exit event by being a C corporation. So you may have to look at the numbers to see if the savings over the next 5 years are going to help you. Jerry?
I understand there are a few states that have put out lawsuits.
Right, that's unconstitutional. It's yeah.
Let's assume those lawsuits are successful. A couple of years, 3 years to work through the system. Does that mean we get tax refund, or we're just screwed on a going forward basis?
So this is an attorney, by the way. This is Jerry Klein. He's a litigation attorney. His question is, yeah, he did. This is going to hurt accountants, attorneys. Yeah.
Klein and Wilson bill and make it miserable for them.
That's right. So that's okay. So what Jerry's asking is, what happens if states, basically take this new tax bill to court and argue that it's unconstitutional under equal protection or something, pick a clause in the Constitution, and they win, and the Tax Act is viewed, at least in part, unconstitutional. His question is, will we get refunds in that? I'm assuming what he's saying is we should have then been entitled to deduct our state and local taxes. These are high tax states that Jerry's referring to. The question is, it would probably depend on what the courts say about that, whether the old law applies or the new law applies, or that provision, if the new law's provision on income tax deductibility as an itemized deduction is ruled unconstitutional, does that mean that the old law applies or something like that? So it would depend.
On the flip side, do things get worse? Are there going to be more reconciliation bills?
Well, I mean, here's what people think. Okay, it's a really good question. So Jerry's question is, can this get worse? And here's something to think about: is that the personal provisions, the individual provisions, are really only in place until the year 2025. The business provisions are permanent. So let's say that you stay a pass-through organization because you want to avail yourself of the qualified business income deduction, that 20% deduction I was referring to earlier. As the years get closer to the expiration of that, you can sort of go back to the old tax rates. If there is no change in the law, the individual provisions, basically sunset, and you'll end up paying the old tax rates again. The corporate rates are permanent. That 21% rate is still permanent. So what you might see happen, if no legislation occurs, you might see people, as we approach 2025, convert to C corporation to get that 21% and to avoid the old way, the pre-2018 tax law. It could get worse if nothing happens, I guess, is my point.
When you say permanent is unless the legislature goes in there and decides to do a new tax act.
That's right. A lot of things could happen under the political landscape we have today. A lot of things could happen. For example, if there is a change in the politics, you might have the other party decide that the deficit that this tax act creates, which is about 1.5 trillion over 10 years, is too much. It's too much. It's just going to cause there to be too many problems, and so they want to raise tax rates. They might raise the corporate rate, because at 21%, corporate rate is an easy target to go to 23 or 24. And so let's say you restructure to get the corporate tax rate at 21%, only to find out that a few years from now that thing's going to creep up. And that's what, if you remember back in '86, and some of you here are old enough to remember the '86 Tax Act, prior to the '86 Act, which was the last most sweeping bill, there were lots of things like that in the code. The '86 law kind of made things a little simpler, reduced the rates and what have you, but they all crept back up to where they were prior to this tax law. So you might find with our legislative process for things to enter back into the tax law. Well, it's a good point. The question is, how do you really tax plan? And I'd say that it's a good question. You really want the law to settle. You really want the law to settle down a little bit and to get some clarification on things. There's lots of problems. But what I would say is, to the extent that the current law can help you, and you can make steps, mitigate your risk going forward, you have to sort of weigh the opportunity to save taxes now with the potential that there could be a law change without any mitigating effect in changing back to the way you were before, or to take other steps. So I would say look at what's in front of you and make changes, or if any, based on what you do know.
I'm pretty sure I know the answer to this, but I'll ask it anyway. Let's say you switch from cash to accrual tax basis. What happens to at the beginning, your gap? There was the stuff that is no longer, the stuff that was accrued last year, but you paid on a cash basis. So this year, it would have been on a cash basis, but now it's accrued.
Yeah, you do. So the question is, if you're on the cash method and then you would go to the accrual method, or I suppose vice versa, what happens to those amounts that you either deducted before, do you get to deduct them again? And that's what we were referring to earlier, although we talked about it really quickly, is that if you change your method of accounting, your overall method of accounting from cash to accrual or vice versa under this law or a normal method change, there are procedures in place to prevent you from receiving a double deduction or from omitting income. That's section 41 of the code, and sometimes the tax geeks will say that's a 481A method change. So you have to go through this process to make sure you capture the omission or duplication. So no, you can't do that, Arthur. Yeah. Any other questions? Oh, we got a couple back. Sean? I think possibly we can work something out. Mina, did you have, or somebody have a question?
Okay,
Okay.
so we're wrapping up. As usual, anytime we have one of these, we have food, we have drinks. So it's a good time to get to meet everybody, ask your questions one-on-one. Sometimes you don't want to ask the question in front of a crowd. So we'll partake outside, and we're here till the last person leaves, sort of, unless somebody's really a party animal. So anyway, enjoy, please spend the time, and we're happy to have you out there. Lots of food, lots of drinks.